Last but not least, we come to deal terms, and we have amazingly Chris, who's going to be joining us right now. But just looking at the cheat sheet right now, type of security is either equity in the company or debt that converts into equity in the round. So whether it's convertible note, a safe, as Erica and Helen mentioned, simple agreement for future equity, or just outright stock. There's a difference between common and preferred stock, whereas preferred stockholders are granted more privileges than common stockholders and can also negotiate liquidation first rights, voting rights, etc. In terms of pro rata rights, you'll hear this a lot, which essentially just gives the investors a right, but not the obligation to participate in one or more future financing rounds to maintain the percentage stake in the startup. So last but not least, liquidation preferences is also a clause in the contract that dictates the payout order in case there is a liquidation event. So, the company either IPOs, it gets acquired, there's a change of control. And last but not least is voting rights. So, investors can, accept or reject actions taken and proposed to the stockholders, such as a sale, additional financing, and other matters. So we have Chris Emme. Hi. I'm so glad to have you here. Can you just briefly introduce yourself and just say a little bit about the angel investing experience, and also what areas do you currently invest in?
Yeah, absolutely. And I'm excited to be participating, and I'm excited too that I got an opportunity to see all the other presenters as well too. It's always valuable to hear from other angels in this world as well too. So. My career basically started as an operator. So I worked in digital media and advertising companies ever since graduating from college. So companies like Microsoft and Yahoo and Rocket Fuel, and had an opportunity to work with a number of different startups and varying degrees of success. And what that did is it sort of gave me a real hands-on experience to what it was like to build and start a company from sort of within. I ended up going to HBS, and as a result, got involved with the HBS Alumni Angels, which was my first jump into the angel investing world. And so I learned a lot. And I think one of the other presenters had talked about angel investment groups are the best way to sort of cut your teeth. And as a result, I saw a lot of deals. I learned about deal flow. I learned about diligence. I learned about structuring deals. I learned about advising. I learned about terms. And so as a result, I joined the board, where I'm helping with a lot of their marketing efforts, a lot of their work efforts. And then on the side, I have a consulting company that takes a hands-on approach to helping companies grow, basically on a commercial front. And as a result of that, in addition to HBS, I found myself putting money to work in about 10 different investments in sort of a combination of companies that I work with, as well as just straight capital investments. So I continuously learn, I continuously read, continuously have conversations with founders as well as other investors. And I think what's great about this is it's a craft no different than anything else. And constantly working on your craft is something that I think is vitally important. So thank you for having me.
That's awesome. So one of the questions that people had asked prior was, have you invested using these different instruments that we mentioned? So convertible note, safe, outright stock, and which ones do you see more often as an angel?
Yeah, it's a great question. And I'll sort of break it down in a couple different ways. So mostly as an angel investor, you're going to tend to see safes and convertible notes. It's becoming more and more common for that to happen. But you're also seeing some equity deals, and it depends on where you are in your investment process. And so much like I think Erica was talking about the processes, if you're in the friends and family realm, if you're in the pre-seed realm, if you're in the early stages, you're probably going to find yourself exposed to more convertible notes. And the reason for that is because valuation becomes really hard to nail down. And so what the note does is it allows for founders to get access to capital without necessarily needing to argue about an exact valuation. As you get a little bit more advanced, you're starting to see advanced in your development, in a company's development and time frame. Equity rounds are more preferable, I would say, and equity rounds are more preferable for a couple different reasons. Most notably, there is the, so in 2015, the Obama administration passed something called QSBS, which is Qualified Small Business Stock. And what that is whether, if you're involved in a company, your stock, if you hold it for a 5-year period of time, will have zero taxes associated with it. There'll be no capital gains, there'll be no short-term capital gains, no taxes. And so ultimately what investors are looking for is if they're going to put in early money, is they want to be able to have equity early so that the clock starts ticking so that they can realize their gains, and whether that's a 5-year horizon or even more, that they can ultimately exit out of that investment without paying any stock or without paying any taxes. So you're starting to see, you see both structures, and I'm very fluid in the debt convertible note piece, but equity generally is more preferable.
Got it. So the second question we have here is, do you generally get to set the terms? If not, is there a way to influence them?
Yes. So yes and no. So generally in an angel environment, and I'll talk about myself as an individual investor, I'm generally not writing checks that are big enough to indicate that I would have the voice to dictate terms. So generally I'm reading terms.
Yeah, like what are the check sizes that you're seeing or like have been participating in?
So I'm writing checks from anywhere from $25,000 to $50,000. And as an individual investor, that's not nearly enough to have the voice to dictate what kind of terms. However, on the other end of the spectrum, if you invest with a syndicate or if you invest with a group, depends upon the structure of that angel group, oftentimes collectively, you can get into the sort of $150,000, $200,000, and depends on the size of the round, that's the amount of money that would probably come along with at least a say in the types of terms that you can indicate for that particular round. So the larger the check, the more voice you have.
Yep, that's live. So the third question we have here is, how do you structure the terms in order to optimize your investment? Like, what are the things that and the levers that you can pull that would really benefit you as an investor?
Right. It sort of it kind of breaks down to 4 different categories. There's the deal economics, and that's obviously the size of the round, the valuation, the option pool, the liquidation preference, which I think Helen was talking about previously, or you actually mentioned in the cheat sheet. So those are all sort of those parameters are dealt with in sort of the deal economics piece. The other aspect is investor rights and protections. And this is where you start talking about pro rata rights, which you sort of mentioned in the term sheet as well as some sort of anti-dilution. And ultimately anti-dilution is really important, especially if you're early, is to make sure that you are not the one that ultimately takes the biggest slug to dilution in future rounds. You have to understand you are going to take dilution as the company continues to grow, but as the company continues to be more successful, your stake, albeit smaller, will be more valuable. Now, there's obviously the concern of a down round, which is something that can be taken into consideration with that second.
Yeah, can you just explain for those who don't know what a down round is?
So a down round is essentially, and I think Erica was talking about the different trajectories of the raise, is if somebody raises at a particular valuation, let's say you come out of your Series A at a $2 million raise at a $12 million post-money valuation. And let's say for whatever reason, like a global pandemic or some catastrophic event or product market fit, there's a number of things that can happen. Ultimately, we're still in the game of risk here in investing, is that all of a sudden the company needs to raise more money, but it can't raise at a higher valuation. So ultimately what happens is they raise money in a B round, but at a valuation lower than what they raised in the A round. So it's not catastrophic. It's not an ideal situation to be in. Oftentimes, or sometimes, you can put terms into an agreement early, which potentially mitigate your dilution in that scenario. So potentially employees or founders or some other people take the brunt of the dilution in that scenario versus some of the early investors.
Yeah, so you mentioned deal economics, you mentioned investor rights. I interrupted you, so
yeah, and then the other ones, so just governance, and that's just how things are structured. You want to Again, the more money you raise, the more voice you have in potentially having a board seat or dictating board seats. But you want to understand the governance of companies. I think you guys will probably remember both Facebook and Snapchat had really unique governances when they went public, which essentially allowed for the founders to control a significant amount of the company. These are primary elements of deal terms that you want to take a look at. And then the last piece is exit sort of liquidity. And that goes to the term you were mentioning as far as liquidity preferences. Where do you sit on the waterfall? And that obviously depends on whether you're entering it from a debt scenario and a note that then ends up converting into equity. Then you become sort of you become an equity holder at that point. You go from being a debt holder to an equity holder at that point. So you're obligated to abide by those rules.
Amazing. So next question here we have is, how do these terms that you've mentioned really vary by industry or stage of company?
Oh, that's a good question, and it can get
a loaded question. Sorry,
but the truth is in the basic format, these terms are fairly standard in a way, and there's ways that you can push pull, and so by industry and by stage, there's not going to really be that much difference. Obviously, as you start getting into later rounds, it gets more into liquidity preference of who sits on the cap table and in what order. But what's really important to mention in regards to this element of angel investing, whether you're an angel investor or whether you're a founder, and you're at this stage where you've gotten interest from investors and you're starting to figure out sort of valuations of the company and what the terms of the raise are going to be, like there's a push-pull between the investors and the founders. And there's a natural tension that exists there, which I think is vitally important. Everybody wants to mitigate risk, and everyone wants to make sure that it's not just a scenario of having equity owners, but actually having partners in the business. So the two ends of this spectrum, the founder and the investor, there's a natural tension, which isn't bad. But it kind of comes down to almost a sense of Marxism, right? It's capital versus labor. And there is a coexistence that can be there. So while terms are vitally important, I would almost argue that terms of a deal are probably more important than valuation in some cases. Generally, the philosophy that I follow is that if you're an investor and you try to get the most advantageous terms possible, you're ultimately going to be ripping the rug out from underneath the founder and the founder's upside, which is who you're investing in anyways. So if you get a really good deal, but you get a founding team that feels that they got taken advantage of, then you're sort of ripping the rug out from underneath the motivation and the hustle and the energy that is required for the labor aspect of this business to actually execute on the promise of the company. So
exactly.
The push-pull
really
in these conversations is always unique.
Because they're day in and day out. So right. You have to be fair, and you have to also make sure that the incentives are aligned. So I think
that's incredibly poignant. You're exactly right.
So I would say in that case, maybe this might be a great question about COVID in your experience right now, just in terms of what you're seeing, and how these terms have changed maybe a little bit.
I don't think the terms have changed so much, and actually Helen had brought up something that was interesting, which was in the discussion about valuations and due diligence was there are a lot of investors now that are looking for deals, that are looking for distressed assets. They're looking to be able to sort of put their cash to good use, and angel investing in growth opportunities, you're not going to find distressed assets. You're not going to find founders that are going out there that are going to be raising money in a panic scenario. Now, it depends on each case that happens, and I'll just give you an example. So about 3.5 months ago, I joined a company full-time, which was one of my investments. So I invested in a company, and then I realized, and I spoke with the founder, and I realized that it would be great for me to join the company to help them commercialize their efforts. We're in the process of raising an A round, and fundraising has become really stressed. And so, like a lot of companies, everybody in the organization took a haircut to their salaries. We slowed down our spending. Obviously, we're not traveling. We're not doing a lot of things. We're continuing to build the product. We're continuing to have business development conversations, and we're continuing to do all the things that would normally happen. But our cost has gotten really low, and not one term has changed on our raise, because we know the value of the company that we have, and we've done the things internally to allow us to minimize the cash burn. And while the telephone calls of our investing team have gotten had slowed down in their responses, we didn't change any of the terms of the investment, because we didn't want this epidemic to ultimately dictate what we raised and what we knew was valuable.
Yeah, so that definitely speaks kind of to the long-term view that you have with the company. And it also kind of harps back to what Sydney had mentioned about, the type of support that you want that comes along with the capital, right? Whether it's angels or VC, you are clearly an operator at heart and you started that way. So that obviously molded kind of how you're seeing things in the angel side. And then, when the opportunity arose, you were able to, join that team. So I think it makes sense on both of those sides. And I mean, the next question, we kind of answered it here, which was, what involvement do you have with the companies you invest in? Apart from joining them full time, is there anywhere else that you support your portfolio companies?
Right. Yeah. And that's a good question. And when I came into it with the philosophy, which is, I think, one of the first questions that you had asked was, I came in with the knowledge of the business from an operator standpoint. I have learned a lot about the financial elements and the legal elements of angel investing. But I try, whenever possible, to make myself very available to founders and help them in whatever capacity they might want. Obviously, my expertise is in the commercialization and the revenue growth of companies. So generally, the companies that I invest in usually need help, whether it's an introduction, whether it's helping fine tune the messaging, whether it's helping to interview salespeople in whatever capacity there is, whether it's joining full time like I am now, acting as a compensated advisor for warrants, or simply just being available to founders in whatever capacity I can. That's where I get the joy. I've only been angel investing for a short number of years, about 4 years. So I don't really have any exits that I can point to. And I'm assuming that would be really fun. But the fun that I get, the joy that I get, is working with founders each and every day to help them grow their business and stay mentally sane through what is a trying
which we're all trying to do right now.
Right.
And that once again also speaks to kind of the type of angel you are. You want to be called up and said, hey, I need this support, which is incredible, right? Because then the capital comes, with your network and, your fellow Harvard alum. So, it's large. And then at the same time, there are some angels who want to just give a check and then just step away. And so those are more of the passive types, the one that just, they just want you to come back when there's a return.
Yeah, so exactly.
Those are like two very different angels. And so, you guys out there, if you're looking for angel money, just to make sure that, you have, you find what type of angel you really want to be by your side. So we'll have one more question here that was submitted prior, and then we actually have a couple of questions as well that you guys are upvoting, so I will go to those. So Chris, what are the top 3 must-ask questions before you invest?
Yeah, well, I'm going to answer that 2 different ways. One, when it comes to terms, even though I don't write a big enough check either, so I don't really necessarily dictate terms, I generally want to ensure that I have pro rata rights. I want to have information rights, which essentially means sort of a free flow of information. And then the last thing I just want to ensure that is in the terms is drag along for the exit strategy. And what that essentially means is that it's majority rules. If there is an exit opportunity or liquidation opportunity, that all those with voting rights have an ability to vote for the actions of the company, and a small minority of people cannot hold back the will of the majority. So they're called drag along rights. And so those are 3 rights that I like to have in these. And they're pretty common. So it's not necessarily somebody who is a small investor would actually have to make a big to-do about in order to get those things added. But pro rata gives you an opportunity to add on more investments down the road to minimize your dilution and continue to take the investment on the upside if you want to. Information's key, kind of goes into who the investor that I am. Like, I like being close to the business and help out where I can. But to answer your question in a different vein, almost as a due diligence piece is, I'm all about revenue and growth. And that's really important, is to understand that strategy. The other strategy is I want to understand how the founder or the founding team is going to retain key employees through an option pool, through a program. Obviously, the team that's there that gets them from A to B is vitally important. And so that's pretty key for me. And then the last thing is exit strategy. And it's not necessarily from a I'm only looking at this from a financial return standpoint, but founders oftentimes are so focused on building a product, raising money, and growing. And they don't really think about that last element of it. And while it's probably not the most important thing that should keep them up at night as they're starting to build their business, it is a seed that I would like to see founders having thought about. Where does this land? Who buys this? What would you like to do? Is it an IPO? Is it an acquisition? Do you want to buy other companies? I like to see a founder that's at least put some thought into that. And then for all of those elements, my only question to them is, how can I help? How can I help with an exit strategy? How can I help introducing you to people? How can I help with your growth strategy? So that's sort of my biggest focus, is how can I be hands-on?
Yeah. And that's fantastic. We'll answer, I believe, one of the questions that you guys have sent us. So how do you balance your investment thesis with your portfolio diversification? So just clarify your investment thesis and then kind of go into how you think about those two balancing. My investment thesis is not as thorough as I think some of the other panelists here. I'm opportunistic. So I've invested in funds that invest in blockchain. I've invested directly in companies. I've invested in ad tech and media and marketing, which is my specialty, all the way to HR tech and logistics. So I almost don't think that I have a finite investment thesis. And sort of given that, I don't really, it's a hard question to answer, because I don't necessarily think that I have a very clear thesis as far as what I invest in. I like to invest in the right people. There's a gut instinct that I try to rely on as far as looking at founders and understanding whether they have that will to win, that will to sort of run through walls and to be able to motivate a team. So that's sort of the biggest element of my investment thesis. And so when I meet people, or I see people, or I get introduced to companies that sort of have that X factor, those are the things that I look into. Yeah, I mean, and just for, I guess, clarification on the portfolio balancing, what is your portfolio? You mentioned your thesis is opportunistic, but how many do you have in your portfolio, and how many do you suggest people even have?
Yeah, that is a good question. So I have 10 investments that I've made, investments between $25,000 and $50,000. And I would take on probably a couple more, but my thesis, and I think this is what your question is that I want to have as much of a hands-on approach as I possibly can. So when it starts to get too big, then I find like I can't make an impact, or I find like I'm not making enough of an impact with any of those. So, it's grown over the years, but I've got about 10 right now that I feel that I have a pretty decent cadence with the founding team. I can be responsive. I've got a little bit of dry powder, so I can come on for later rounds. And that's kind of the stage that I am with my portfolio, is that they're now starting to emerge from that angel round into sort of raising in their A round. So it's sort of exciting to see that process, and it's exciting to be able to have the pro rata rights to invest again. So that's kind of where I'm with that.
Awesome. Well, I think those are all the questions that we have right now that we can answer in this time frame. But thank you so much, Chris, for really, capping off this entire masterclass with deal terms. I know that it got a little bit intricate, but I also want to make sure that if you want people to contact you, please put your contact info or anything that you want them to share, whether it's like, maybe your Twitter, maybe your website. And yeah, I think this was fantastic. So thank you again for joining us. I
appreciate it. I'm just going to put two things. One is the link to the HBS Alumni Angels website. That's a great group if you're looking at potentially looking at an angel investment group. And then I'll also put, believe it or not, I actually utilize LinkedIn a lot. So I'll put my LinkedIn portfolio profile as well too. So I can message through there. But thank you all very much.
Awesome. Thank you.